Can long-term capital gains push you into a higher tax bracket for Roth conversions? That's what we'll be talking about in today's video. Hey folks, this is David McKnight, best-selling author of The Power of Zero. If you liquidate a stock that has long-term capital gains in the same year in which you do a Roth conversion, can that push you into a higher tax bracket for the purposes of that Roth conversion? The short answer is no. Let me explain. It's important to note that long-term capital gains get taxed in a completely different tax cylinder with completely different tax rates when compared to ordinary income such as a Roth conversion. Let's talk briefly about the ordinary income tax cylinder. Ordinary income, including Roth conversions, flow into a tax cylinder where some of that income gets taxed at 10, some at 12, some at 22, some at 24, some at 32, some at 35, and some at 37%. Short-term capital gains flow into that very same tax cylinder and get taxed at those same rates. Long-term capital gains, however, are a totally different animal and have their very own tax cylinder. There are only three tax rates in that tax cylinder: 0, 15, and 20. And the tax rate at which your long-term capital gains get taxed actually depends on your total income in that particular year. So how do you define your total income for the purposes of determining your long-term capital gains tax rate? For most people at or near retirement, you begin by taking your gross income and then subtracting your standard deduction. You would then add in any long-term capital gains. That total income is the number that is then used to determine your long-term capital gains tax rate. If that total income is between $0 and $83,350, then your long-term capital gain tax rate is going to be 0. If that total is between $83,351 and $517,200, then your long-term capital gains tax rate is going to be 15%. And if that total is greater than $517,201, then your long-term capital gains tax rate is going to be 20%. So why is it that long-term capital gains taxes don't bump us up into a higher tax bracket for the purposes of calculating tax on Roth conversions? It's because you always perform the ordinary income tax calculation first. That one is set in stone before we ever calculate a long-term capital gains tax rate. Once we determine the tax on the Roth conversion, we then add the long-term capital gain on top of the ordinary income to determine the rate at which long-term capital gains tax rates are paid. Let me illustrate with an example. Let's say your tax status is married filing jointly and you want to do a $75,000 Roth conversion in 2022. Assuming you have no other income, you take that $75,000 of ordinary income and subtract your standard deduction, which is $25,900. That gets you to your taxable income, which is $49,100. That means you could realize a long-term capital gain of $34,250 without paying any long-term capital gains tax. How did I arrive at that number? I took the $83,350 threshold and subtracted the net taxable income amount of $49,100. That leaves us with $34,250. That's the amount of capital gain I can realize and still remain below the $83,350 threshold where I pay 0 capital gains tax. As long as I have you, here's one other tiny wrinkle. Let's say you have a $10,000 capital gain. Let's also say that your ordinary income after subtracting out your standard deduction is $78,350. At what rate will you pay tax on that $10,000 long-term capital gain? Well, because the first half of that capital gain, or $5,000, is below the $83,550 threshold, you wouldn't pay any tax at all on that portion of your capital gain. However, the second half of that capital gain, or $5,000, is above the $83,350 threshold and would be taxed at a 15% long-term capital gain tax rate. In summary, you don't have to worry about long-term capital gains bumping you up into a higher tax bracket for the purposes of Roth conversions. Why? Because the tax calculation on the Roth conversion always occurs first. Could a Roth conversion, however, bump you up into a higher tax bracket for the purposes of paying long-term capital gains taxes? The answer, as I've shown today, is yes. If you need any help navigating any of these issues in your retirement plan, head on over to davemcknight.com and click on the Work with David button. I'm happy to lend a hand. If you have any comments or questions, feel free to drop them into the comments section below. I answer all of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.